Good day, fellow investors. We continue with our investing series on key investing concepts that are not discussed enough, and today we'll discuss waiting for a crash. As I make the videos, I'll put all the links in the description below, and if you like this series, please smash that like button and consider subscribing. And this is also summarizing the comments, the great comments you always put there, which I really love. And I have no problem in my portfolio, I just have too much excess money that I have trouble putting at work at these prices. 30 to 50% drop would be good. And yes, of course, all these prices in the market, if we look at our intrinsic value, downloadable in the description below, everything is extremely overvalued. You can expect returns of 5–6% for most of the companies. Good compared to interest rates, but from a risk-reward perspective, pretty risky for stock market investing. But waiting for a crash is really a problem. And on my Alibaba video, Joe says, adding to Baba at this stage of the market suggests that you don't believe a market crash will happen anytime in the future or at all. And I don't care about crashes. I'm looking for businesses that will transcend the market or economies. Crashes will happen, the problem is I can't time them. And also, this is a great comment, I took it from my research platform, and Scott says, thanks for sharing your knowledge, but I know it is impossible to time the market, but history tells me that the market experiences corrections and recessions on a regular basis, which create wonderful buy time for stocks. In regards to index funds, would it be a reasonable strategy to hold my monthly contributions in cash or deploy the cash and then, when the market goes through a correction, invest? This feels really well from a mindset perspective, but let me show you that it doesn't really work like that. If we just look at the S&P 500, yes, it's great if you bought here, 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 but let's say that you said, okay, I'm here now, I will wait for a crash to happen to deploy the money that I have. This is the S&P 500 at 1500 points 8 years ago. Of course, it never reached 1500 points again. It just went up, up, and up. And if you save money, and sooner or later this up, and up situation happen every 10 years, every 20 years, then you're just sitting, and then what is most likely is that you invest in fear of missing out, and then you have this next. So this is always the same story when it comes to investing. You are investing in stock prices. Yes, it feels great if you buy when something crashes, but the key is to understand the value of what you are buying. And going back to my template, comparative template for investing, I did analyze the S&P 500, and then you have to know what to expect from an investment. We have calculated dividends, a 3% expected dividend. The intrinsic value in my case for the S&P is 1500 points for a 10% discount rate. If I change the discount rate to 5%, I'm to 2200 points. If I'm happy with a 2% dividend, then I am with 3000 points, so 5% expected return, and that is about it when it comes to investing. And you have to see how this value fits you, not the stock price, because you never know. And we'll also discuss something like an inflationary crash in the next video, so you will also get the risk and reward of waiting in cash better when we discuss this. For a more detailed strategy on lump sum versus dollar cost averaging, lump sum works better in 70% of cases and waiting in 30% of cases. Check my dollar cost averaging versus lump sum video from a more academic perspective. Of course, subscribe for more videos in this series, and I'll see you in the next video.